Good afternoon, everyone. My name's Keith Gilmore. I'm the Regional Head of Business Development for Northwest Europe at Scope, and I'd like to welcome you to this webinar. Our subject this afternoon is the outlook for England's social housing sector. Privately funded housing associations have emerged over the years as one of the main providers of affordable homes. Faced with rent cuts and reduced capital funding, the associations have had to rely increasingly on alternative sources of funding. In the challenging aftermath of the COVID-19 crisis, this is a good moment to take stock of the sector's financial performance and prospects. So it's a great pleasure to have with me today the Regulator's Head of Finance, Mark Windridge, together with Jakob Suwalski and Thibault Vasse, the authors of Scope's UK housing rating methodology. Mark has worked for the regulator for 6 years, spending much of his time speaking with existing and new investors into the sector, along with their advisors and legal teams, all of whom are involved in the sector's funding arrangements. He previously worked for over 20 years as the head of risk at a major European bank, which specialised in the provision of finance to the public sector. Jakob and Thibault are respectively the director and senior analyst within Scope's sovereign and public sector ratings team. Before we get started though, let me just do a little bit of housekeeping. If you have any questions during the webinar, please type them in the chat window on the right-hand side of the screen. We'll aim to answer as many as we can during the roundtable discussion. At the end of the webinar, you'll also get a very short questionnaire asking for your feedback. Please take a minute, and it really does only take that to fill it in. Your input would be much appreciated. So, with that out of the way, let's get started. Mark, the UK social housing sector has seen major transformation in recent decades. What have been the key developments from a regulator's perspective, and what role does the regulator play in avoiding financial distress in the sector today?
Thanks, Keith. Yeah, it's nice to be with you today. I think fundamentally, it's absolutely fundamental that social housing tenants should be able to enjoy decent quality housing without concern to the proper management or financial viability of the provider. The regulator exists to try and see that this is achieved, which is underpinned by law and delivered through 5 basic roles: the registration of providers, collection of information, grading of providers, investigation of issues and enforcing solutions, and the identification and communication of trends and risks at a sector and sub-sector level. Nevertheless, it should be remembered that providers are private entities and are free to innovate their operations given changes in their external environments. And this really is the foundation of our co-regulatory approach. If we are looking for the catalyst for where we are today, then perhaps we can look to the 1988 Housing Act, which really set the course back then. This introduced the concept of leveraging public grant with private debt. And just over 30 years later, providers have drawn some 85 billion to support their development or refurbishment programs. For certain, there have been challenges since that change, but providers have adapted. For example, to the reducing grant levels and to the rent reduction regime. If providers have upped their game, including a handful with the newer for-profit status, then the regulator has itself become more focused and demanding. A couple of high-profile problem cases around 15 years ago prompted such change. This included a focus down onto those providers with more than 1,000 properties, since it is they who own all but a few percentage of the properties operating in the sector and the debt as well. We've put in place revised data requirements for providers, which was coupled with an adaptive deep dive every 4 years. We asked providers to provide long-term forecasts and business plans, and then asked them to enhance this by stress testing those plans and considering scenario analysis. We do listen to the sector's reactions to our proposals, and there was a clear pushback a few years ago against living wills, for example, and ultimately we just required associations to produce or to create data rooms. Publication of gradings is followed by many stakeholders. We take a failure to achieve the prime governance grade or the first and second class viability rating seriously. These are actively followed up with action expected over a short period. But regulation can't stand still and doesn't. One of the many consequences of the Grenfell tragedy has been a recognition that a strong, proactive consumer regulation regime is needed. Responsibility for this will be with ourselves. We are determined, though, that this won't divert us from maintaining our strong focus on the governance and viability standards.
Thanks, Mark. Jakob, Scope have recently published a new rating methodology on social housing providers, which includes a focus on the institutional framework. What does that assessment capture?
Yeah, thanks, Keith. Our framework assessment includes indeed several aspects which Mark touched upon, and is the first step of our analysis of a social housing provider's creditworthiness. In principle, within our framework assessment, we assess systemic factors that capture the supportiveness of the institutional framework, and we determine an indicative rating floor for the ratings in each of the four domestic social housing sectors within the UK. So in this part of the analysis, we look at the strengths of regulatory standards and oversight, as well as the regulator's intervention power, which accounts for the regulator's ability to intervene in cases of financial distress or mismanagement. And in our view, that the regulatory framework drives the overall level of risk and the quality of governance in the domestic social housing sector. We believe that strong regulatory oversight with comprehensive regulatory standards and robust ongoing monitoring of providers, financial reports, strategic plans, governance, as highlighted by Mark, support the resilience of the sector in the respective country overall, while effective regulatory interventions can help avoid cases of severe providers' distress. And in addition to these regulatory components, our framework assessment also captures social housing policies and government support schemes, which were mentioned by Mark. We assess here how targets to increase the housing stock are matched with tangible policies, which are key drivers of credit quality for the UK social housing sector. Social housing policies and governmental support schemes are important, in our view, to provide a strategic direction, long-term viability of their business models, and affecting ultimately operational performance and reliance on debt financing. And as Mark highlighted, regulation is not allowed and doesn't stand still, also given developing profiles of the providers. And the framework under which UK social housing providers operate has been overall subject to changes due to multiple macroeconomic and financial factors over the last decade. And when changes to the framework are made, we examine under our framework assessment the predictability of such reforms, as well as the extent to which providers were included in the decision-making process and given appropriate advance notice to minimize disruption of any of their operations, for example. And therefore, our framework assessment is a forward-looking assessment, and a change in the framework, which would result in a notably different degree of supportiveness, could lead to a rating change of a provider. However, depending on the changes under our framework assessment and the standalone credit profile of the rated entity. So to conclude, starting our analysis of a social housing provider with an assessment of the framework and defining an indicative rating floor for the ratings in the respective country captures important assumptions of our approach. In short, we believe that the framework under which a social housing provider operates also affects the individual credit profile. We believe that before looking at a provider's income statements and prior to an assessment of the key characteristics of an individual balance sheet, first, we need to fully understand and capture and evaluate the systemic factors which can evolve over time. And here our view is that a very supportive institutional framework with predictable policies, with potentially more robust government support schemes, more effective, proactive regulatory framework would lead to a stronger credit profiles in the domestic social housing sector, and thereby can act as an indicative floor for the ratings in the respective sector.
Okay, thank you, Jakob. Mark, everyone's obviously been through a very challenging time over the last 18 months. How has the social housing sector performed against the backdrop of the COVID-19 pandemic?
Pretty admirably, Keith. While internally colleagues game planned for all sorts of downside scenarios they could think of, providers were already adjusting to working remotely and focusing their attention on the fundamentals they needed to do. Protocols for delivering emergency repairs were implemented, and they worked out ways to deliver on their legal obligations, like gas servicing, although we'd have to admit it took them a while to get going on this, but they caught up by October at the latest. Performance was monitored through a series of monthly surveys, which we started in early April last year, and we engaged with providers who were reporting the most serious difficulties, basically to gain assurance that they were appropriately managing the risks that they were facing. By March this year, it was clear that the operational position was stable in essential services, and providers were starting to plan to catch up with the general maintenance and major repairs which hadn't been completed over the last year and a half or so.
Okay. Thibault or Jakob, I mean, do you, as analysts, share Mark's view on the sort of robustness of the sector in the pandemic?
Hi, yeah, Keith. Maybe I can actually jump in for this one.
Yeah, sure. Thank you.
Yeah, no, thanks. Thank you, Mark, first of all, for joining us. And in terms of what Mark has just said, it definitely resonates with our view of the sector. We have seen some short-term impacts on the sector. Mark mentioned a few. There's been an increase in arrears. It's taken longer to turn around properties. It's slowed down progress with safety checks and remedial works. But in general, we do think that the sector has done a very good job in terms of managing these pressures. And overall, it's very well positioned to weather the crisis with limited pressures on credit quality. It was interesting for us because we actually built the methodology from the ground up in the midst of the pandemic. So maybe I can just point to a few things that we observed during the crisis that have sort of informed our view of the sector from a credit perspective. So one thing that's worth highlighting is really the role that the regulatory framework has played in ensuring that housing associations were prepared and could respond to the crisis effectively. So one of the things that I'd like to point to, and Mark mentioned it already, is the importance of stress testing and mitigation planning. This has been a regulatory requirement for several years now. And governing boards of housing associations are used to consider, a broad range of risks to their activities and establish mitigation strategies on a regular basis. So when COVID hit, This is really what allowed housing associations to respond to the crisis swiftly and to implement the contingencies that were needed to mitigate the impact on their financial position. And that was really evident to us when we were looking at how the sector was performing throughout the crisis. So, stress testing is just one of many aspects of the framework, but it does underscore the importance for us of having a deep understanding of what are the regulatory requirements for housing associations and how do they contribute to the sector's resilience in case of shocks, as was the case with COVID. Another key aspect that I'd like to mention is the counter-cyclical nature of housing associations' business model. So I'm not saying anything new here, but I do think it's worth reiterating that structurally, demand for social and affordable housing outweighs supply in England. And when the economy enters a recession, demand in the sector increases. So what we expect to see and what we have seen is that there's going to be sustained, strong underlying demand, which will continue to support housing associations' activities. And this is actually very different to other sectors that we can rate, which typically tend to move with the cycle and who saw their demand shrink due to the pandemic. So, for us, what's more meaningful from a credit perspective than really the short-term impact of COVID-19 is how the policy framework has changed and actually become more supportive for the sector, right? So the government increased grant funding under the Affordable Homes Program. They also reversed the trend of declining rents that Mark mentioned earlier, and that's supportive of housing associations' long-term planning, and it underpins their credit quality. So, ultimately, our ratings are through the cycle. So we focus more on structural developments, and those structural developments for the sector tend to be linked to changes in the institutional framework rather than GDP growth in any given year. So I've just mentioned that the sector is counter-cyclical. I think there actually is some debate about whether that remains true today. The reason being that many housing associations have actually diversified into more cyclical activities. So that includes market sales and private rentals, for instance, and they use that to cross-subsidize their core activities. That being said, there's a lot of heterogeneity in the sector, right? You have some associations that are much more reliant on those income streams than others. And those associations are more exposed to the cycle. And we would expect to see, greater deterioration of their credit metrics compared to those associations that have a more moderate exposure. So what that meant to us in terms of our analytical thinking is we needed to find a way to get a bird's eye view of the sector and to identify the associations that are most resilient and those that are most exposed relative to the rest of the sector. And that had an impact on how we modeled our analysis of standalone fundamentals. So those are some of the high-level takeaways that the crisis had for us. I think we'll have the opportunity to discuss, what that means in practice in terms of how the methodology works, but I think I'll leave it there.
Okay, great. Thank you, Thibault. Helpful additional colour. Mark, can I come back to you? Really wondering what your thoughts are on how the sector is developing in terms of financing and investment activity.
Yeah, thanks, Keith. It really started off with a change. Started with the financial crisis and its consequences, and up till then, banks had really provided the vast majority of long-term debt, and that really is financing which best suited their needs. As the banks largely refocused onto shorter-term revolving debt, there was still evidence that there was a pent-up investor demand for high-quality assets such as social housing. This was first evidenced by Affinity Sutton, now Clarion, who launched a 250 million 30-year bond in September 2008. And this really moved the market onto its current trajectory. It had an external rating and just asset cover as a financial covenant. unlike previous bond issues, which had largely been rent securitizations and/or aggregations one way or another. Some 17 investors purchased that Clarion bond back then, and great store was made back then of the fact that pension funds were involved in that bond. The just under 6% rate of fixed rate of interest at the time was good value, absolutely. But clearly things have changed and moved, and even just last week we've seen Flagship achieve just under 2% for their 40-year 250 million bond. Like a number of recent issues, it was tagged with a sustainable finance framework status. Indeed, in the period since lockdown, there have been a plethora of deals at around the 2% level. A good part of those monies has gone to refinance existing legacy bank debt, even if this has meant breaking those legacy fixed rates. By the end of the second quarter last year, the amount of drawn bond debt had exceeded bank debt at 42 billion against 40 billion, albeit the banks had another 22 billion arranged, which was undrawn. It appears that providers are taking advantage of the current market. They know that the future will see them looking to balance the development of new social housing with fire safety costs and a potential second decent home standard, which will incorporate decarbonisation targets. While commentators have brought in their forecasts for when they think the first rate hike will be, given the spectre of inflation, it does seem likely that providers have still got time to go to market at these sort of attractive levels. Attaching an ESG or sustainable label to these facilities is, at the very least, attracting new investors into the sector.
Yeah. Jakob, anything perhaps that you would like to add to what Mark's already highlighted?
Yeah, thanks. So I would definitely agree with Mark. So in view of also an increasing market awareness and overall movement towards social and sustainable credentials, ESG also provides an opportunity for housing associations, at least to reach a larger pool of investors. The social housing sector also has a growing need for additional investment. And indeed, I would say housing shortage and sustainability together belong to the most urgent issues facing the sector. And we can observe that several banks are taking a proactive approach to ESG and providing incentives to improve environmental and social performance in form of, for example, those sustainability linked loans. And under the terms of such loans, a component of the interest rate is dependent upon the borrower meeting specific sustainability indicators to be agreed with the lender, for example, with metrics, what we observed linked to childcare qualifications or incentives linked to employment support, so also demanding more and more services of typical social housing provider. And this rather innovative financing mechanism has become increasingly popular in the UK in recent years. So the next step, social and or sustainability bonds could also be an opportunity for associations further to access a larger pool of investors. And then with the capital raised, this could be used to finance the development of new homes and could be used for refurbishment to meet safety and higher environmental standards. However, listing such bonds requires association to measure and report on their ESG credentials, and positive in this regard. We think that housing associations already capture and report on significant volumes of data. And more recently, a new kind of sector standard for environmental, social, and governance reporting has been emerging, developed by a working group last year. And this can help support to structure the governance of a loan or bond to, for example, determine any interest rate, also reduction in relation to social and environmental achievements. So we believe that social housing associations will encounter a growing number of questions from investors around ESG and what the housing association strategy is around ESG. And to conclude, I would say that although ESG can represent a new challenge in terms of reporting requirements for a provider, ESG credentials, standardized metrics could complement a provider's reporting of existing strategic targets. And finally, as Mark said, to support the access to a wider pool of investors.
Yeah, okay. Thanks, Jakob. Perhaps if we just stay with the financing theme a little longer, a question for the analysts. How do you look at the standalone fundamentals then of housing associations from a credit rating perspective? Sure.
I think I'll start, Keith, and then Jakob will be glad to add.
Sure.
I think, you know, what's clear to us is that we place a lot of importance on, you know, what's going on in the policy and regulatory frameworks. When it comes to standalone fundamentals, we have two models, right, that allow us to analyze them. One is a quantitative model which looks at, you know, key credit metrics, which are typically used to assess the credit quality for these types of organizations. And the other is a catalog of qualitative assessments. And I'll mention how they work in a bit, but essentially both produce a score, which we call the standalone credit score. It goes from 1 being the weakest to 100 the strongest. And when we do this standalone analysis, we recognize that housing associations don't operate in a vacuum, and that there's a strong interplay between the institutional framework on one end and the standalone credit profiles of social housing providers on the other. And in our view, using hard thresholds to assess key credit metrics can be problematic because financial indicators for these types of organizations need to be viewed in the context of an evolving institutional framework. So just to give you an example, if I, as an analyst, see an increase in arrears for a provider, the question is, does this reflect really a deterioration in the, you know, the credit profile of that specific entity? Or is it because there's been a change in the framework, for instance, due to the transition to universal credit, which affects all the providers in the sector? And if that's the case, the question for us is, how are other associations performing compared to the provider that I'm rating? So to answer these questions, the way we've designed the quantitative model is to benchmark the performance of peers to the rest of the sector per credit metric. So we don't use hard thresholds like some of our peers do. What we do is we use the global accounts that Mark's colleagues produce, which covers the financials of all the largest providers. So this gives us that bird's eye view that I mentioned before. And then per credit metric, we identify the strongest entity that we give the highest credit score of 100 and the weakest entity that gets the lowest score. And this gives us a range. And then we place all the other providers within this range and calculate their scores based on their distance to the maximum and minimum values. And this allows us to evaluate how weak or strong a provider is compared to the rest of the sector. So that's one dimension of the analysis. On top of that, we have the qualitative assessments. The way, just very briefly, I mean, the way they're designed is to act as a complement to that model that I've just described. So they capture analytical components, which we can assess purely in a quantitative way. And where the quantitative model uses historical data, this model also incorporates forward-looking assessments. So we would take into account business plans, financial forecasts, and by bringing both of them together, we feel gives us a very comprehensive assessment of risks that cover not only operational and financial risk, which are the more traditional risk pillars, but also ESG risks. And I think I'll let Jakob pick up on that.
Yeah, thanks a lot, Thibault. So ESG considerations overall are material to social housing providers' risk profiles and are also captured in our assessment of the framework, while the typical governance considerations are captured in our assessment of quality of financial management, adequacy of provider strategic plans. However, under our approach, we also capture additional ESG risks in a dedicated analytical section under the standalone profile. And for example, regarding environmental performance of a provider, we think that housing policies, starting again with the framework, are focusing more and more on environmental standards and benchmarks with more scrutiny of energy efficiency and environmental impact of buildings. And that's why providers which are displaying rather weak environmental profiles, low energy efficiency, could face relatively high transition risks. And providers that fail to ensure the adequate energy efficiency could also face a regulatory pressure, including the need to invest rather heavily to meet market standards. And with this component of this standalone analysis, we examine the environmental impact of a provider's activities and analyze also the policies and practices implemented to monitor and improve its environmental performance. And the social component from our approach evaluates the provider's social performance in terms of delivery of new social housing, and also addresses affordability challenges in the local markets while accounting for regional differences in demand for their services. So we also consider to the degree to which providers' properties meet national safety and quality standards, as well as how providers foster resident empowerment and transparency. And finally, under governance, we assess the strengths of a provider's quality of internal, external reporting processes, which support transparency and also accountability, and also limit risk. So we also assess the degree to which key personnel have adequate expertise and experience to effectively manage the organization, and our governance assessment is supported by considering the good record or track record of providers' compliance with regulatory standards, including considerations of publicly available governance grades from the respective regulator.
Okay, thanks both. I can see we've got a few questions that have come in, but perhaps just before we move to Q&A, what I'd like to ask each of you is perhaps a few words on your outlook for the sector, with perhaps highlighting in particular what and where you perceive to be the key challenges. Mark, perhaps we could start with you.
Yeah, thanks, Keith. Given the sector has been raising finance for public finance for over 30 years, it's really remarkable that there have been no losses for funders over this time. A tremendous reputation that has been built up, it would be so easy to break. But we have worked really hard to put the regulatory tools in place to flag problems early. And we continue to evolve those tools as the market evolves. There's a relatively new cohort of providers that only lease property, and these are a concern to us. These mostly have limited equity and very thin operating margins, and I'm afraid rescue of these types of providers may be quite difficult to deliver.
Jakob, your thoughts?
Yeah, many things. So I would say that one key challenge is the housing shortage, and associated to this the needed large-scale investment amounting to tens of billions of both. So to build new quality homes that are affordable and modernize existing stock to meet higher regulatory standards, and also the carbon targets set by government policies. And this high investment spending needs have been caused by multiple factors and trends which will be difficult to reverse in the short term. So one could observe in the UK over the last decade that there was a lack of government funding for social housing, while the cost of land, so the value of which has increased fivefold around since 1995, which pushes up the cost of building a new home. And while the need for new homes is evident, the current social housing stock is in need of refurbishment to meet the new. We talked about fire safety standards to align with policy standards, and refurbishing this existing social housing stock and investing at the same time in new home construction is a challenge. On the other side, the low interest environment has led to high property prices relative to the low wage growth. So longer term, we could also observe it's also fits to the European context overall, but in the UK, the average house prices have risen much faster than wages. And how house prices and rental costs have therefore become, let me start, unaffordable for many young people. And at the same time, also given that people are living longer and longer, this increases also the demand for social housing. And to conclude here, public investment, the funds, this is vital. But private investment and then additional funds will be needed, and it will play a critical role and also lead to higher debt volumes in the sector, I believe. And to help tackle the country's shortage of this affordable housing, new providers should be incentivized also to enter the sector.
Okay, thanks, Jakob. Thibault, your summary in terms of outlook and concerns.
Yeah, thanks. I'll try to go quickly. I'm conscious of time. Let's say, my input is actually more of a question mark for the long term than an immediate challenge, let's say. And one of the things that we're mindful of is the UK government's post-COVID policy trajectory. In view of the large buildup of public debt, right? We had a deficit of around 300 billion pounds last year. Now I think the Office for Budget Responsibility is projecting a deficit of 170 billion for this year. I think what that naturally begs the question essentially of if and how the government will try to consolidate its public finances in a post-crisis world. If you look back at what happened with the great financial crisis of 2008, in many ways, the post-crisis austerity program that followed and led to spending cuts was more disruptive to the sector than the crisis itself. So that is something that's key. I mean, for us, for the short to medium term, we're still projecting, continued support for the sector. If anything, the crisis has really demonstrated how harmful inadequate housing can be for individuals and families, and it's definitely strengthened the case for more investment in the sector. There's also been a recognition from the government that what the sector needs is a stable financial environment, right, to support the delivery of new homes. And now we have a multi-annual funding plan of £12 billion. It's spanning through 2026. We also have the commitment to maintain the current rent policies at least until 2025, I believe. So that does provide some stability and visibility for the sector. And we're not expecting, our view at Scope is that we're not expecting to see a rapid fiscal consolidation like we did after the Great Financial Crisis. That being said, we've yet to really see the details of the government's medium-term fiscal strategy. And there is some uncertainty about, some policy developments which could affect the sector somewhere down the line. So again, this is more of an open question rather than an immediate challenge, but it's something that we're mindful of, and obviously we're keeping a close eye on.
Okay, thanks very much. Okay, let's turn to some of the questions that have come in. Okay, first one's clearly from someone who's had a look at the methodology. So, social housing sector has strong ESG credentials in general. Do you think that your ESG risk analysis will always result in positive adjustments? I guess this is one for the analysts. I'll let you skip this one, Mark.
Yeah, if Jakob is okay with that, I'll actually take it. He's been hogging all the ESG content so far. So the short answer to that question is no. The ESG risk assessments that we make won't automatically provide an uplift to the ratings. There's no doubt in our minds that this sector has very strong ESG credentials. In particular, regarding the social aspect, it's social housing. So by the very nature of their activities, housing associations do perform well on ESG. But we would argue that this aspect really already permeates the credit analysis, right? So when we look at the importance of social housing in the government's policy agenda, when we consider government support schemes, even when we look at the level of regulatory oversight, all of these elements already reflect the important contributions that the sector makes in terms of social value. When we look at ESG risks in the standalone analysis, what we're trying to assess is the level of ambition that specific provider has in terms of enhancing its ESG performance. So to what degree are ESG considerations affecting the decision-making process? How are the provider's efforts translating into tangible results? So we can make positive assessments, but we would need to see that provider is, demonstrating that it has a robust understanding of its ESG risks, and that it has in place a strategy to address those risks and to enhance its ESG performance. So it's not automatic. We do recognize that in general, this sector does perform well. And the trends have been positive, right? The focus has been increasing on these considerations, and housing associations are building up their capacity to address it, to moderate, and to communicate it to the outside world, let's say.
So individual performance is still important.
Yes.
Okay, another question that we have, the importance of the regulatory and institutional framework is fairly well understood, but many housing associations are moving towards integrating also a commercial strategy within their main strategy. How do you take that into account in your risk rating methodology? Again, one for the analysts.
Jakob, do you want to, or should I? Yeah.
Yeah, please, Thibault.
Sure. I'll start. No, so I think that's a great question. We did touch on that earlier. So again, it's true that increasingly so we are seeing diversification away from the core social housing activities to more commercially driven activities. There are a few ways in which we assess that. One is that when we look at one of the qualitative assessments that we have looks at the structure of revenues. So what we try to understand is, how large of a share are those activities in terms of that provider's, turnover, recognizing that by nature, those activities are more volatile and there is a bit more risks associated to them. Another question, and I'm sure that Mark is well versed in this, is on governance. If providers are diversifying into these activities, it is a viable way to cross-subsidize their activities, but there needs to be an understanding of the risks there. There needs to be sufficient expertise to be able to be successful in those activities, and that is something that we would assess under the governance pillar, for instance. So yeah, there are multiple ways to approach it. I would say that one, looking at the revenue structure, and two, focusing on governance would be the way that we address those risks.
Okay, thanks. I'll try and squeeze one last question in. What is the value of your rating approach relative to the big three? That's a punchy question. Jakob, I guess this is probably for you.
Yeah, no. I take it with pleasure, and I would like to first highlight that our methodology is, first of all, the result of effective outreach to the relevant stakeholders in the sector, including the regulator of social housing, several advisors, banks, pension fund manager, in addition to the providers themselves, so that we can better understand the framework under which providers operate, and what kind of rating assessment is required to support the investors' lending and investment activities. We discussed this question also bilaterally with some market players in the past, and from our perspective, 5 analytical highlights have emerged from this discussion. So first, we will assign ratings to UK housing providers with only one methodology. This is different to some other agencies which apply a set of methodologies, and then we decided to go for an all-in-one rating approach for UK social housing providers, so that our rationales, for example, for rating differentiation within the sector are more transparent and more easy to follow from a reader. Second, we start with a framework assessment, as individual credit profiles of providers are also impacted by the framework setup or policy changes. And the first analytical step of our approach that does not only provide a rating floor, but any changes of the framework assessment might also indicate structural changes of key credit metrics, like Thibault pointed out today. So our framework assessment is always a forward-looking assessment. The third highlight is that I would say we leverage the very detailed data sets produced by certain regulators of social housing, and we compare with new statistical approaches the individual credit ratios of peers within the same framework on a relative basis too. So we acknowledge thereby that financial data need to be viewed upfront and in the context of an evolving framework. And our approach ensures with this method that the selected ratios we apply are more meaningful compared to the application of absolute thresholds. The fourth point is that our sectoral view easily detects the strongest and weakest entities, but also the differences between the stronger entities on the business and financial risk profile. So we provide an extended portfolio view. And the final analytical highlight is that our approach includes a separate ESG risk profile assessment under the standalone analysis, as ESG risks have material implications for the creditworthiness of social housing providers. And while some providers have embedded sustainability targets as key metrics referenced in sustainability-linked credit facilities, ESG reporting standards are quickly developing, and that's why we integrated this also in our approach.
Okay. I'm conscious that we're running over time here, and there are still a couple of unanswered questions. What we'll do, apologies if we haven't answered your question specifically, we'll come back to you independently on those after the event. So, I mean, it falls to me to conclude this afternoon's event. Let me thank Mark, Jakob and Thibault for your time. And also a big thank you to everyone who's joined us today. Quick reminder to take a look at the questionnaire before you go. It's been very much a pleasure to have you all with Scope today. Take care and stay safe. Thank you. Goodbye.